Okay, guys, this is being recorded. One thing I mention at the beginning of every single webinar is watch this again. The reason why is because it will sink into your long-term memory. If you just watch it once and you decide to implement this, let's say a month down the road, you're going to have to probably review this again to get all of the little nuances that I talk about. So anybody can teach you how to build a long put spread. I'm not going to lie. You can find out how to do it online, but people won't teach you how to implement that. And there are certain things that you need to follow in order to implement this strategy, in my opinion, because it will help you increase your probabilities of success and, you know, avoid some major pitfalls that can happen with even this simple strategy. So please follow along and watch it again once you get the opportunity relatively soon, you know, within a couple of days, really. All right. Anyway, my name's Eric Wilkinson. You may recognize me from mainstream media as the Wolfman. I actually started trading in college with some money I had earned, and after graduating with a finance degree, moved to Chicago and started trading on the floor. And in that time, I've traded everything from stocks, financial futures, commodity futures, and options on all these products and just about all market conditions. Believe it or not, I started out with a psychology degree and then flipped it over to finance. All right, this basically says any opinions, news, research, and analysis or other information contained in this webinar is to be considered general commentary and does not constitute investment advice. And I might even be talking about certain stocks in my portfolio, or I might be talking about my directional assumptions, you guys. That doesn't necessarily mean I'm right or that you guys should jump on board with me, okay? I want you guys to have your own assumptions and have the arrows in your quiver to take advantage of that, all right? Please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Also, you can follow me on Twitter at Wolfman's Blog or our parent company at ProTraderStrat. And I'm going to go over this really quick. It's options 101 because some of this, a lot of people end up watching these long put spreads or long call spreads as an entry-level type of strategy. So I want to make sure you guys know some of these. Remember that delta is an effect on the option premium in relation to the underlying. That means what we're saying is for every dollar move in that underlying, let me pull this up. So it's basically for every dollar move in the underlying, so up or down, delta is going to change, or delta is going to affect that premium, okay? So if our delta is 45, if we have a 45 delta and the market moves up by $1, then our option will increase by that 45 cents, okay? So vice versa, if the market, and this is assuming calls, if we look at those same calls and the market moves down by $1, then our premium will decrease by $1. They'll go down by 45 cents, okay? So pretty easy. And then gamma affects delta. So gamma goes with delta, and it's talking about the second dollar move. So you have to take the delta. When you're just looking at it, it's like at current. If you're just looking to what your premiums would do if there was a $2 change, it's delta plus the gamma, okay? And that would tell you what that second dollar move in the underlying, how that would affect your premium. And theta is the thief in the night, and for every day that goes by, that premium will decrease by the amount of theta, or how much that thief is going to steal from you every single night. And Vega is going to be one of the most important things with one of these strategies, or any strategy, to be quite honest, whether it's even a naked strategy, because we need to know when volatility is going to be our friend or when it's going to hurt us. And what I mean by that is if volatility goes up, then our premiums go up, all right? Our premium will go up. And if volatility goes down, then our premiums will go down, all right? So it is directly correlated with volatility to our premiums. So if volatility goes up, it's going to affect our premiums, or our premiums will go up, and it depends on what kind of strategy you want on, right? If I buy a strategy, I want volatility to go up. all right? Why? Because that jacks my premiums up. I can be directionally wrong, and if that volatility jams up enough, it will help out my strategy. I could be profitable even. If you guys remember in the flash crash, or even in 2000, way back, I'm dating myself, of course, but back then, you know, we had those big moves that we actually saw people that had bought calls make money, or at least not lose money. And that was a completely incorrect directional move. All right. If you had bought a call and the market went down, you would have expected to lose it. But the volatility jacked so high that people actually were saved by that had bought those calls. Okay. So volatility really is going to be the determining factor, or Vega is going to be determining whether or not we're buying an option strategy or selling an option strategy. All right. And like I mentioned, this is on the long put spread. A lot of people can tell you, like I said, how to build it. I build it a certain way. What we're looking for is I usually go with the in the monies. The reason why is because I like to get that spread to be about a 50-50, risking one to make one. So I usually start looking at an 84 delta. That's about, if I'm looking at the in the money, I'm looking at about an 84 delta here. All right. You know, obviously if you're at the money, that's going to be close to a 50 delta. But what we're trying to do here is catch it when the market has made a big move and we're looking for a correction. Okay. So we're trying to do this with this strategy versus that long put to reduce some of our risks. All right. That you know, you're risking it all with the put. With this, we're going to limit some of our risk with that, but we also will limit some of our profit potential, obviously, because this is going to be wherever that strike is, that's where we really can't make any more money on it. All right. And because it is a long spread, we are looking at it being a debit put spread. All right. You are always going to be doing this for a debit if you are doing a bear put spread, or you have that bearish assumption with this put spread. A long put spread is a bear put spread, and you are going to be paying a debit. All right. Like I mentioned, we're always going to be paying a premium, or, you know, you're always going to be doing this for, I don't know why I always do that. Debit. All right. You're always going to be doing it for a debit. Theta decay. We want to kind of get rid of as much theta decay as we can. And what happens is the closer to expiration, theta starts increasing. So, you know, if we have less days to expiration, theta starts increasing. All right. We increase the theta. Right. So we want to get away from this. So we are probably going to go out on the scale a little bit further. We want more days to expiration, and we want volatility to expand. We can't always know exactly whether or not volatility is going to expand or going to contract. But one of the things we can do is get ourselves into a situation where volatility probably won't go much lower when we're looking at the long put spread. All right. We want volatility to be as low or as low as this underlying has seen in quite some time. All right. And by doing that, we're going to be able to figure out if volatility is low or Vega is low by using IV%. And I'm going to show you how to come up with this number. That is key to knowing whether or not an underlying has low or high volatility. All right. Waiting for a correction after a big move up, then corrects below the put, putting it in the money, right? Yes. We would love to see, you know, I told you we were buying, we were looking to buy an in the money put. That one is already there, but the one that we're selling is going to be an out of the money put. And that's the one that we want to get tested. All right. And it's not going to hurt us if the market shoots even below that level. Okay. You know, we're going to be at max profit then. And some people will be like, won't I get assigned? Well, remember, you always have the right, but not the obligation to put that to somebody else. So if somebody put these puts or put the underlying to you, then you can offset it with the one that you have already. So you can already offset that. It's going to end up being the same thing. Okay. All right. Our essentials to success is picking the right underlying. This is one of the first things we come up with, right? We don't necessarily know that we're doing the long put spread at this point, but we do have to have a directional assumption, all right? Directional assumption. And our assumption is going to be negative, all right? We have a negative directional assumption. That's the first thing that we come up with when we're starting to look at this, all right? So I've got a directional assumption in XYZ, let's just say, all right? Just to be simple. I've got a directional bearish assumption in XYZ. Now, what I have to do is look at it. All right, well, I'm bearish in XYZ. Maybe we just started flipping through the numbers. You heard something, or flipping through the charts, or you heard something on TV, or maybe you saw something, a new product out there that you think is going to like literally tank this company, or they maybe bought somebody or whatever. Whatever comes up or makes you come up with that directional assumption in XYZ. Next thing we need to know is this stock appropriate to trade options, all right? If you're going out there and just buying and selling the stock, you probably have a pretty good tight bid offer, all right? There is going to be a tight market for that, but that doesn't always correlate to options. So when we're picking the right underlying, it's basically we need to know whether or not this underlying has options that are tradable. And what we're going to be looking at is we're going to go over to the option montage, all right? And my rule for this is going to be any stock that is less than $100. Let me get one more thing up here. Let me pull this up so I can draw on this here. So what we're going to be looking at is the closest option, monthly options to expiration. Now, somebody could say that these 2 days to expiration, that's the monthly that's closest to expiration. There's nobody trading that. So we want to go to the ones that's basically close to 35 days to expiration. That's where the most eyeballs are, if you will. So we're going to go in here and look at this. And any stock that's under $100, we need that to be less than 10 cents wide. And on this, it obviously works. So let's just throw up NVIDIA. It's over $100 stock. So any stock that's greater than $100, then we move the decimal 3 ticks to the left and we come up with about 17 cents, right? So the decimal's here and we go 1, 2, 3, and we come up with 17.5 cents. All right, 17.6 cents. You could round it up to say 18 cents. So what we need to do during open market operations, we come down here and look at these options that are just outside the money. We just want outside the money on the calls or the puts, whatever you prefer to look at, and make sure it fits that rule. And this is during open market operations. Right now we are after the close. It still fits that rule. But remember, it won't always fit that rule after the close, especially maybe on a Friday, you're doing some analysis and stuff like that, getting set up for, or Sunday night, getting set up for the week ahead. This rule will most likely not apply then because people have canceled all of their orders, or at least most of the people have canceled their orders ahead of that or right after the close. Think about it. If you have a day order in there, as soon as that market bell rings, you just see all your orders get canceled, all right? So that creates wider markets after the close. So we want to make sure this rule is during open market operations, but you can see it pretty much even fits this during the after hours here. So any stock that's less than $100 Twitter, my rule here is less than 10 cents wide to the bid offer, and you can see Twitter is still following that rule after the close. So make sure you've got that down because that is really important. So picking the right underlying. If it's greater, I took off my thing here. Let's just do this. If it is greater than $100 stock, you just move the decimal three places. All right, 3 places to the left. 1, 2, 3. All right. And if it's a less than $100 stock, then we need it to be equal to or less than 10 cents wide. All right. So that's the rule for picking the right underlying. If you're finding your option XYZ, you've got your directional assumption. First thing you need to do is look at that option montage and make sure that it fits this rule. If it's greater than $100 stock, if XYZ is, greater than $100, we move the decimal 3 places. If it's less than $100 stock, we need it to be at least equal to or less than 10 cents wide to that bid offer on the options that are closest to expiration, like 35 days is really where we're looking at for that one. Can you clarify the statement? Put it to us and to offset. Yeah. So when you are short a put, basically, if you're short a put and the market starts moving against you, somebody can put that stock to you. I mean, assign you is really what I should have said. You could be assigned the stock. If you're doing calls, that means you're getting called away. It means somebody's taking your stock away from you. All right. So you get put the stock, means somebody gives you their crummy stock at a price or whatever that isn't beneficial to you necessarily. And when your stock gets called away, it's usually because it's not necessarily beneficial. All right. And that's when, your short calls are in the money at expiration or your short puts are in the money at expiration, meaning you put those short puts on below the market. They were out of the money in the beginning. The market has moved down and now your short puts are in the money. You are in jeopardy of somebody putting the stock to you, meaning they're taking their long stock and giving you long stock. Okay. If a broker sees you have a spread, less likely to put it to you because they know you can assign it back. Exactly. They don't want to pay if the broker sees you have a spread on, which I don't know how easy that is anymore. But at the end of the day, they don't want to pay. It's a little bit more expensive to assign stock or take stock away and stuff like that than it is to just get out of the strategy. All right. So with my rules for the strategy, I don't want you to ride this thing out. When those puts go into the money, get out of this. When those short puts go in the money, get out of the spread because you are going to be at your profit potential. It may not be, your max profit potential, but you're going to be at the profit potential that we have for a guideline. We want to get in and out of strategies quickly. I don't like to be in a strategy very long. I don't like to think about it. I mean, if you watch the daily market commentaries where I'm talking about all my trades and stuff like that, I mean, I love it when I'm in and out of a trade. I did that a couple of times this week. And, that's a rare occurrence, but that's what we want to do. We want to get to our max profit and find another strategy that has a high probability of success, like immediately move on. All right. Picking the right environment. All right. So the right environment here is when we are looking at implied volatility percent, right? I kind of mentioned this before. And we want this to be for a stock. We want our implied volatility to be less than, we want this to be less than 50%. I would say for most of you guys, especially newer traders, make sure that it is less than 30. All right. And then the IV percent for an ETF, because it's a basket of goods. If you have a higher risk tolerance, you want it to definitely be less than 30. All right. And if you're a newer trader, go less than 15. All right. Right now, because we've experienced really high volatility, I would start going with the lower numbers there. All right. Because, you would want to expect you're going to get more bang for your buck if you start seeing that volatility start to increase. All right. But, don't be doing this strategy if it's greater than an IV percent of 50. All right. So how do we figure out IV percent? It sounds pretty complicated, but it's really not. What we want to do is we pull up the platform, and let me actually get rid of this. With this, for the, whoops, I keep forgetting I don't have my, I'm flipping back and forth here. I'm going to stick with that. I'm going to go here and say, actually, give me a second here. I'm totally being a potato. All right. So what we want to look at for the right environment, like I said, we want low implied volatility percent. Well, IV percent is a pretty simple fraction. Basically, we take the current implied volatility and subtract it by the low implied volatility, and take that sum and divide it by the high IV minus the low IV. All right. So we take those two sums and we divide them by each other. Less than 30% for stocks and less than 15% for ETFs. That would be the safest bet. Yes. All right. So now I'll pull up the platform. I'm going to have to do this with, all right. So we've got that fraction and we want to pull up the platform and kind of do the math ourselves, because not everybody's platform has this. You know, I have the code that goes in here to create implied volatility percent. And if you have TD Ameritrade, you can put that in here as well. Current IV percentile, you know, Twitter's 9% there. But let's just check their math, because sometimes even their math will be off, you guys. And some charts on the implied volatility down here, this is where it usually comes from. There can be a break in there. All right. I also have friends that only look at this, you know, 6 months out. All right. They kind of discount it further out. I don't have a problem with that either, because, you know, at the beginning of the year, we saw some really huge volatility happening. It's still calculating in there. Are we going to see that, you know, in the next 52 weeks? Maybe not. So if you feel like that was just an outlier, you know, drug stocks, when they have trial results, get these massive spikes outside of the blue. Well, they might not have another trial result for another 5 years. Okay. So that might be the time to discount that spike. If you're not expecting another trial result, then you may never see volatility for those drug stocks to go that high. All right. So that might be a time where you discount that major outlier. But I'm going to go with it as it being relatively normal here. So we're going to look at the high on Twitter being 90. The current we got is 33. And the low we have to figure out here is 27. So we've got 90, 33, and 27. Those are the only data points we really need. So we've got the current, which was 33, minus the, what did I say it was, 27? And then 90 minus 27, all right? So we take those two sums and divide them by each other. So we've got 33 minus 27 is 6, and we divide that by 63, divided by 63. So if I do my math, I'm coming out with about 0.9% or something like that. You know, 63 goes into 600, probably 9 times, right? That's, did I do that? Yeah. 9, close to 8 times. Real close to 8 times. Yeah. So basically, you're going to come into, or 0.08. So you're going to kind of do the math that way. All right. So that would fit this rule for Twitter. All right. And then the next thing we need to look at is, you've already seen this slide because I messed up. Thank you. John said it's 9.5 to be exact. I didn't have my calculator up. And, you know, it doesn't have to be like exact. I don't want you to like really, you know, beat yourselves up over it. You know, you're looking at something and, you know, with the environment, just know that you want, let me talk about that a little bit more. Just know that you want that volatility to go up. You know, one of the things I forgot to talk about here is, you know, the reason why this is important. Implied volatility is forward looking. It's what is expected to go forward. And, you know, if you guys have watched the daily market commentaries or anything else, you guys know I'm kind of a contrarian. I am a contrarian. I'm not going to lie. But with implied volatility, every underlying has like its bit of a range, okay, where it's comfortable staying within. You can see that Twitter got some massive spikes out here, but you know, even during earnings, right here and right here, you can see that that's about as high as it went. You know, these were possibly outliers here, okay? And with that being said, you know, it is a ballpark, and this is forward looking. But the thing is I want you to get in this. The reason why I said below, you know, a 30 IV% for a stock is because you could see when it gets way down here, or even when it got way down here, it wanted to rise. And believe it or not, even this little bit of rise in there, you know, going from basically 28 all the way up to 34, let's say, 28 to 34, we got a 6-point increase. And if we go back to what we were talking about in the beginning with volatility and how it affects the premiums, you know, volatility is saying for every 1% increase here, then our premiums increase by the volatility coefficient, all right? So this is right now 5, all right? So we could say that when we were seeing that low volatility, we can just back it out, you know, to 27. So we're just going to subtract out 6 percentage points. Well, 6 percentage points subtracted out of this gets us down to that level. You know, it's rounded up to 33, so we round it back down to 27. So we're taking 6 percentage points away. So 5 cents comes out for every 1 percentage point. So that means that these had increased, these options right here had increased by about 30 cents. All right? That's 30 cents added into here from, you know, just 2 or 3 days ago. That's not including the market moving or anything. So that volatility increasing, you know, had you bought this, then that would have helped, even if you were directionally wrong. If you bought these calls and it went down by 30 cents, but that increased by, you know, 6 percentage points in that time in the last couple of days, well, then you would have been offsetting the downward move. All right. If it moved down by $1, but the volatility increased by 6 percentage points, you know, it would have only decreased. If the market went down and I had bought these calls, it would have decreased by 41 cents, but the volatility increasing would have offset most of that. And same for the puts. On the put side, volatility still increases and decreases, but here, you know, had you bought these puts and volatility increased, well, you would have gotten paid double, because you would have gotten paid for the delta on the dollar move down, right? And the volatility increasing, you would have gotten paid by that increase, all right? So that is the beauty in this. We're trying to play both of those, all right? You know, John, I have a tendency to look at the calls. I don't know why when I'm teaching these, but they are on the put side. Delta, note that delta is negative, okay? So with the puts, we're going to be buying some puts here, and delta is negative. That means if the market goes down by $1, think about down by $1 is a negative, right? So a negative plus a negative delta means that it's positive. So if the market goes down by $1, if this goes down from 42.93 to 41.93, then these premiums will increase by the delta, because a negative move, a negative dollar move plus a negative delta is positive. All right. Just like a dollar move higher going from 92.93 to 93.93, that's a dollar increase here. Then that's plus a negative, means that this delta would subtract out of the premium. That makes sense? All right, so remember that. You know, your math still goes together. And if you're looking at the calls, the market goes down by $1, then a negative to a positive delta means that these would decrease then, right? We are looking at the puts though. So we want a negative directional move. And the beauty in the put spread, when you have this bias and you actually get that negative move, usually when the market moves down, volatility goes up. All right. It's not always the case. The market can still move higher and still see volatility come in, because usually when the volatility is coming into the calls, it's fear of missing out. FOMO. All right. It means people are seeing that move happen and come in and rush the calls because they want to catch on this massive move higher, and that premium increasing, because if more people are buying and coming in buy, that jacks up the premium. The premium getting jacked up affects the volatility. It's part of Black Scholes. I'm not going to go into Black Scholes though today, you guys. I'm sorry. I hope you guys didn't start this webinar thinking you were getting Black Scholes education. All right, so picking the right duration. This is what I was talking about, that thief in the night that comes and steals our premium. All right, and these are at the monies. We're not necessarily doing the exact at the monies, but this gives you a good representation of what that thief does. You know, out here in the timeline, he is not very aggressive. He might be taking, 1 or 2 cents out of here. And then the closer we get, he's taking out 2 cents. Now he's taking out 3 cents a night, maybe 4 cents a night. And then now he's starting to take out, say, 6 cents, and then taking out maybe 10 cents a night. And then down here, he might be taking out 15 or 20 cents a night. All right. So that volatility, or that theta coming out, and we bought premium. You want 15 cents coming out or 10 cents coming out? No. So we want to move out the curve. Now, I'm not saying that you need to go out as far as you can to see that you're only losing a penny a night. All right. At that point, you're paying a lot, that you're going to be, doing the $4 signs kind of on the spread. So I'd kind of rather get in here, in this area here, because it isn't necessarily as expensive. And I drew that really bad. So let me see if I can just get rid of that there. I really kind of want to be outside of 45 days. So kind of in that wheelhouse there. And maybe even a little bit further, just depending on where the options are. Because right now, there are some options that aren't accessible right in here, and it has to do with quarterlies and stuff like that, the quarterly options. And we're kind of, at the timing of this webinar, it's a little bit funky on those, some of those monthlies a little bit further out the curve, right? So, but we want to get outside of 45 days. So, we want to be about greater than, somewhere greater than like 50 days-ish, right? And again, that's not a hard number. If it was 49 days, maybe. If you thought that move was happening really quickly, then I wouldn't worry about it too much. But also, the further out the curve, it also gives you more time to be right? Especially with long strategies. So we want to get further out that curve. All right, and the right strikes on this strategy. We need to know that as well. The right strikes we're going to be looking at here. We want to try to pay for that extrinsic value, all right? The extrinsic value is really what duration, that theta, we were talking about theta. Well, we can also pick some strikes that will kind of get rid of theta. Well, we're going to try and get rid of as much theta, which is extrinsic value, as much as we can, all right? So if we can do that, that would be great. So when we're looking at the right strikes, we're going to be looking at somewhere, like I said, about as far out or in the money I want to go is about an 84 delta. But the sweet spot is right in between those. I would say to the 64 delta, somewhere around in there. The reason why we're looking at that, this 84 delta is one standard deviation away. All right. I didn't do a very good standard deviation thing, but one standard deviation away is where that 84 delta comes into play. And this one is about a half a standard deviation away. All right, so that's what we're looking at. You know, we're talking about probabilities. When you're looking at this 84 delta, you know, the probability of that one being in the money at expiration is about 84%. This one's only got about a 64% of being in the money at expiration. All right, so but ultimately, what we want to do is build this strategy out. So we are building this strategy out. So our debit. Can everybody see this blue? Is that easy to see? Our debit, we want our debit to be equal to or less than 50% the width of our spread. All right. And I'm a terrible writer. All right. So, you know, that means like if it was $10 wide, you know, from our in the money. So $10 wide, let's just say we were doing the 100 put, we bought the 100 puts and we're selling the 80 puts, okay? Well, that's $20 wide. Those are $20, so we would want to pay equal to or less than $10 in that example. So let's get rid of that. That would be $20 wide. Right? So $20 wide, we want to pay less than or equal to $10, all right? All right, and then moving on to our exit strategy. This is important, right? Because I am not looking, you know, if I pay $10 for this spread, my max profit, and we'll get to that, you know, in detail before, is $10. I pay $10 on a $20 wide. Well, my max profit is $20. Well, what we're going to be looking for here is trying to get out of this strategy as soon as the market goes down and hits that 80. All right. That would be the first thing. As soon as my short puts get hit, the probabilities of that happening are pretty slim. It's only about a 16%. It's going to be about a 16 to 20% probability of being in the money at expiration. But our probability of the market testing this 80 put is 2 times the delta. That's a floor trader hack for you. 2 times the delta is the probability of getting kissed or probability of getting touched. That being said, we want to try to get out when the probabilities are in our favor. And if we can get 2 times the probabilities of being in the money, then get out, right? So a 50% increase in our premium is what we're looking for usually. So I paid $10, I'd be getting out when it was trading $15. All right. And that most likely will happen if it is gone down and traded $80 from where we put this strategy on. You know, do I want to ride it into the end of the day and wait for these puts to be in the money at expiration for that extra $5? You know, think about it. If this happened in the next 2 or 3 days, no, it's not worth it. We're 50 days away from expiration or 75 days away from expiration. And this happens in, you know, 5 to 10 or even 15 days. Do I want to keep this strategy on for that other $5? That risk? No. Yeah, you want to buy about the 84 or 64 delta put and then sell what delta? Well, we're going to get to that. It's going to be around that that 20-ish to 20-ish delta, okay? And we'll talk about that when we start building this out real quick. But let me go over these max profits, and then you guys can also start throwing stuff into the questions box. That's how these people are communicating with me. That's how I'm finding out what they're saying. So if you guys are bearish, you have a bearish assumption in an underlying, you can start throwing them out there also. I'll start getting to these questions real quick in just a second. All right, so our max profit, I kind of mentioned this. It's that long put minus the short put. the long put minus the short put. So we were talking about the, if our long put was the $100 strike, and this one was the $80 strike, right? And then we said we paid $10. Well, then our max profit is $10, right? Right? So 20 minus 10 equals the $10, right? So that's pretty easy to figure out. And we're paying a debit. So basically 90% of the time, or 95, maybe even 99% of the time when you're paying a debit, that's your max loss. Butterflies are an outlier, but anytime you pay a premium, let's just say the max loss is that premium you paid. And then the break even is the long put minus that premium paid. So we were looking at it as the $100 strike. We were looking at the $100 strike here, and we paid $10. So when the underlying is trading $90, that is our break even. Okay, now here you go. This is, I can't give you the break even at any given point of the day, right? Because we talked about this. The underlying might not move at all. Okay, and if the underlying doesn't move at all, but we see volatility spike, or maybe the underlying moves higher and volatility spikes, well, we might see our break evens change a little bit, or our premium change in and around there. So this is at expiry. All right, that is the only thing that all of this break even means. That's the only way I can give you the break even is at expiration. All right, that means all the volatility is gone, all of the theta decay is gone, and where the market is at expiration and this underlying, our break even would be $90. All right, but that can adjust depending on, because if 10 days goes by and I did the 100 strike or whatever and volatility spike, it could still be trading right around, wherever I put it on was, let's say 90. The underlying would be trading 90 then. Let's just say the 100 put. Well, the underlying is, 10 days later, after 10 days, it's still trading 90, but we saw volatility, IV go up. Implied volatility shoots up. Well, that volatility increasing could have offset some of that theta and stuff. So we could still be sitting there at our break even. All right. Maybe not the perfect example on the pricing and stuff like that off the top of my head, but pretty close. When you have a minute, could you clarify, how did you say the 64% is the half standard deviation? All right, so I don't have a chart for it, but I'd have to look at it. David, throw that out, and I'll try and find a chart at the end when I can dig through my my stuff. I've got a chart for that. All right, so we want to pull it up. First one I saw throw out there is Cisco. So we want to look at Cisco. I think it was Cisco, right? Cisco is the first one we're going to look at, and we have a bearish market assumption on it. All right. So first thing we expect maybe it to come down to here. Who knows? But what we need to do is first come out with the implied volatility percent, right? So we need to find the high, which is 44. Let's call it. I'm going to round it up to 44 just to make my math easier. 44, 23, and the low is 13. So pull this up. So we've got 44, 23, and 13. So we got 23 minus 13 and 44 minus 13. All right, we take those two sums and divide them by each other, right? So we've got 10 divided by 31. And so we are right around, that's got to be around a 33% or something like that, pretty close, is what we're looking at there. So that fits the rule. I know Banu is like, she loves risk, right? So we're going to go with a little bit higher risk here. So just double check it, 33. Oh, look at that. So we want to go a little bit first. We need to say, all right, is it the right underlying? Cisco, everybody's heard of Cisco. Is it option tradable? We don't have to move the decimal. It's $50 stock. That's less than $100. Are these 10 cents wide to the bid ask? Yes, it is. So we're good. Now we've got the volatility. That's right. Now we need to know the duration. And like I said, sometimes we're not going to have right now with those, with the way everything's kind of laid out. So we're going to have to go out a little bit further. I don't want to deal with this close to expiration there. Also, another brilliant thing with this is if we pulled up this and said Cisco, we could look at their earnings. I don't have a problem putting this strategy on in the monthly that has, or even further out than where this earnings event is, but again, I'm not going to ride this through earnings because we can see what happens to volatility after earnings, almost perfectly consistent that it gets volatility crush. We want to avoid volatility crush. Okay. So what we want to do is get into a situation where we have that volatility in our favor. All right. So I would want to be out of this strategy before this event happened, unless maybe, the market rallied on me like right away, like tomorrow it shot up and all of a sudden I'm looking at a max loss now. Well, then I might write it in through that economic data point because, I'm already at max loss. I have nothing to lose then. All right. So if you got nothing to lose, then just leave it on as far as I'm concerned. But if you're at any type of profit, I would get out because you could still see this directional move in your favor. Now, this is an example where it probably you still would have been a winner on it, but you can see that volatility coming out would have been fighting you, from 40 all the way down to 24. So you're getting like 16 percentage points coming out, 16 times 5 or whatever. You can see how big that number becomes and how much money you would lose on just the volatility. So that's why it's important to get in while it's low. We expect this to come down. I'm kind of with you. I think it's coming down to 47. I'd be good with that. All right. So with that being said, we're going to kind of come in here and start at around the 84 delta. I hate doing half strikes, so sorry, I'm going to go a little bit closer. I'm going to buy the 55s. And one thing I talked about, remember I said we want to kind of pay off as much extrinsic value as we can. Extrinsic value is what theta decay is. It's basically, intrinsic value is what this option is worth. And I can tell you this option is worth about $5.80. So the rest of it is extrinsic value. All right. And the way you figure out intrinsic value, 55 minus 49, that gives us $6, right? So $6 is really what this strike is worth, because at expiration, if we were right here and this was the very last day and the market closed, this 55 strike would be worth exactly that $5.81 because the last is 49.20, right? So $5.81 is exactly what this one's worth. So there's, somewhere in between that dollar. Well, one of the things to look at is over here. The easiest thing to do is kind of look over here, and this usually correlates very closely to what the extrinsic value is. I don't care a ton about getting rid of all of the extrinsic value, but we are looking, you can just kind of look across and say, all right, this is kind of what I want to pay off. The corresponding calls tells me what the basic extrinsic value is. So I'm going to go with that every time. I don't want to go through the math in my head and burn myself out. So about 70 cents. So I go over here and I'm going to look to sell that one. This is what I was talking about. It's going to be about that 16 delta. All right. It kind of works out that way. Now we need to figure out if we are about 50% of that width. Are we paying 50%? I've got 40. So I've got 8. 8 plus 5 is 13. So $6 is less than that 50% of max profit, right? Or 50% the width. So this would be a good example of something to do. And Remember, it's a 16 delta. It means, in the next 100 days, I have about a 32% chance of this actually trading, right? But I only have about a 16% chance of this being in the money 120 days from now. Okay? So go with it when the probabilities have shifted in your favor. I would say that if it comes down there and tests 42, get out. This is our exit strategy. Isn't when this is trading, what did I say the width was, 13? Isn't when this is trading 13. We're not looking to get out then. I'm looking to get out of 50% of that max profit. So, you could look at this as being when this is trading at around a 50% increase, so $3. So when this is trading around $9, so 50% increase in the value of this. So when this is trading around $9, I'm looking to get out. And if it trades 42, I'm sure you are going to have your max profit, all right? I'm not going to go through all the delta and stuff like that on all of these, but you can almost assure yourself that that's going to happen. Okay. I'll throw out Twitter again. We really didn't go into it as an example. So let's just say, and remember, you would want to get out on that earnings, and there's an earnings right here for Twitter. So I'm bearish in Twitter. It looks pretty bearish. Maybe it's going to come down here. Whatever our bearish assumption, however we come up with our bearish assumption. I'm gonna go with the Nova on this one. All right, just to give a different month. It's outside of that 35 days to expiration, even outside of 45 days to expiration. So I'm good with that. I'm outside of that big theta component. You can see right here, 2 cents a day. Here it's going to be 2 cents a day. So it doesn't decrease that much. So, but inside of here, you can see the theta really starts ramping up, and there's only a day left, and that's why. So we're going to go out. We could even go out a little further, even in D's if we wanted to avoid it. It's still 2 cents. So we're going to pick this one, because then I'm not going to have to pay very much. All right. That's the thing. If your theta is going to be all the same across the board on these, then go to the closer, because you're going to be paying a little bit less. So you're risking less money, right? Yeah, I'm giving up my time to be right, but I'm not expecting to be in this that super long. And I want to give you guys a different example. So with this, I'm going to be looking at, I'm not going to go this is about as close as we're going to find to that 84 delta. So I'm going to go with this one. Going to look over at the extrinsic value. I'm not even going to bother with this. I can see if it's pretty close. 80 cents is what I'm looking to pay off. So I'm going to go down here to the 37. See, that's right around the 80 or that 16 delta we were talking about. So that falls in suit. So we've got how far? $13 again. This one breaches that a little bit. $6.50 would be closer. So, that would be kind of a yellow light. When I was talking about those volatilities and your risk parameters and stuff like that, you could say that we could look at this as, the red light, green lights and stuff like that, where we have kind of a stoplight, right? And, we got a green light, we got the yellow light, and then we got the red light. All right. Red light would be too extreme. Basically I'm paying 75%. That would be a total red light. But, I'm just going over just a little bit here. So I would have to say that we are looking at more of a yellow light on that. And, if everything else is totally, blazing green on this, like we've got the right underlying, we've got super low, super duper low implied volatility. Maybe it's 0 or something like that, and this was the only thing that kind of like was sticking out as a thorn in our side, that it wasn't quite that rule, then you have a yellow light. But, if this was, the bid offer was maybe, 13 cents, that would be looking at a yellow light. right? And IV percent was, 52 or something like that. That's kind of a yellow light. And then we've got this, that's a yellow light. That's just way too many. I'd just be like, let's drop this. Let's get out. All right. I'm going to find something else that fits a little bit better. Too many yellow lights, kind of walk away from it. You start breaching those. So, I talk about these rules. You can bend them a little bit, especially if you have higher risk tolerance or you have a super bearish, like you are more bearish than a matador, then take it for that. All right. Twitter has lower IV and may get a green light. You know what? It probably does. But the one thing is, it does have lower volatility. But I can tell you the reason why this volatility is higher here than in December is because this is where the earnings is. I've got earnings in there and I don't even know it, right? I can tell you almost in complete certainty without even looking where theirs is. So November 15th is when these expire, November 15th. So let's look at a chart that has the earnings in it, and November. So the options that expires on November 15th here. So these options have the earnings in them, right? So that's why the volatility is higher for this month than here. Okay, so I should expect to see the volatility in this monthly to actually outpace the December, which is why I'm a little bit more willing to go with that. But great point, Banu. So would a call spread for a bullish stock use the same deltas and similar process, just the opposite direction? Yes, Chris, I did that one. I did that one earlier on in this course. So we started out with the bullish assumptions, and so yeah, we kind of went over that with that one. This one, if you watch that one with the call spread, it's a little bit more touch and go whether or not all of these rules. It's almost a pick 'em on the put side to make this all the rules fall into place. The call side, sometimes you got to play around with the months and stuff like that, kind of like what Banu was talking about. Yeah, Chris, I'll let you off the hook on that one. When volatility expands from the lower vol for this strategy, won't the vega increase as the stock drops and lowers? Well, you were dead on there, John, until you said lowers delta. The deltas as the stock goes down are actually going to start increasing, right? So for every dollar down in the underlying, $1 down, this underlying is going to increase, or this premium is going to increase by 31 cents. The second dollar down, it's going to increase by, or the delta and the gamma, right? The gamma is going to go with the delta, and it's going to increase by then the second dollar down, 36 cents, right? First dollar down, this will increase by 31 cents. The second dollar down, we've got gamma goes with delta. Second dollar down, this premium will increase by another 36 cents on top of that. No, don't ever say sorry. If you got a question, you guys, I want you to ask them. Somebody else has probably got that same question, so it needs to be answered. Max IV for stocks is 50. If you have a lower risk tolerance, the max IV percent for stocks is 30. All right. If you have a high risk tolerance for trading, then your max IV percent for an ETF is 30. And if you have a lower risk tolerance, your max IV for the ETF, which should probably be around 15. All right. But always try and start in, get out a little bit outside your comfort zone if you have the opportunity. I mean, anytime you start to get comfortable, start increasing it a little bit. So which has the bigger impact, the increase in IB with Vega or with Delta. It is, it's all kind of relative. If you look at it 1 percentage point to $1, I would have to say the Delta is going to be right. But, volatility usually has a tendency to move rapidly. So it is, it's hard to say. I can't give you an exact on that. I mean, I've given examples where I've showed, and it's all in the daily market commentaries, you guys. I talk about I give like really good examples in the daily market commentaries because that's when I'm seeing them happen. You can't, I don't cherry pick anything. So I can only give you when it's happening and or throw people under the bus that are on TV saying it wrong. I do that too. So, but I give those examples when I see them, and it's more akin to in the daily market commentaries because, I can't write down every single trade and, take screenshots and all of that stuff, you guys. It's just because my computer would be jacked with stupid stuff that I never erase. All right. Also, which option increase with the implied volatility percent? Short put options or long put options? Which options increase? Well, all of the option premiums will increase with an increase implied volatility, with implied volatility increasing. All the premiums will increase with that volatility going up. All right. Now, you have to ask yourself, what side do I want to be on? If I believe volatility is going to increase, then I want to be a buyer of premium because you're kind of buying volatility. All right. And if volatility is extremely high and I expect it to come out, well, then I want to sell premium or sell volatility. All right. So that's why I'm trying to get you guys set up with this implied volatility percent, is because right now with like Twitter, it's extremely low. It doesn't mean that it can't go lower than 27, but we can see it rarely, if ever, goes below 27. All right. But we can't just look at 27 or 30. We can't just look at 33 right here because this 33, 41, all of these things doesn't tell me anything because I can go over and look at Tesla. It's always a great one. Why didn't that come in? Tesla. And, all right. So Tesla, we go over here and look at this and you can see they're in the 50s, but look, we go in the charts. Tesla never goes below 43. So, 43 is extremely low. That's when you would be buying premium in Tesla. So don't just look at that number and come up with your, buying or selling premium because you'd be selling or you'd be buying premium all day here in the other ones, right? Thinking it's going to go higher. Well, those are extremes. This is an extreme low. You would be buying premium in Tesla and selling premium in Twitter. All right. So make sure you do the implied volatility percent because all stocks are not created equal. Some stocks are more volatile. Tech stocks are more volatile than utility stocks. All right. Utilities are boring, right? They pay a big dividend. They're boring stocks. They don't go anywhere. But that means there's not a whole lot of volatility in there. So we need to figure out what that number means. Because it's not always the same. Okay? Anybody else? All right. Well, then without further ado, we've got this strategy or these courses. There's 3 of them here, you guys. All of these are great. Volatility crush. I talk about that. That I think is one of the most important ones that we have to offer. And usually we don't give a great deal on that one. This is a great deal. This is a better deal than we normally give for just the volatility crush. So that's a really good one to get. And basically then you're kind of getting these almost for nothing. And these other ones, floor trader hacks, volatility crush. Understanding volatility is going to let you sleep at night. The hacks is going to help you streamline your process, just like knowing what intrinsic value is versus extrinsic value, right? Probabilities, I only touched on the probabilities with Delta. There's all kinds of things that it talks about with Delta, but all of these things over here are great about streamlining your process. I also try to help you make sense of it all, right? With that one. And then options basics. If you are a beginner, this is a great one. Even if you've been trading forever or learn to trade options from watching CNBC or something, you definitely need to watch this. Those guys on TV need to watch this one too, because although they shouldn't actually, because they gave me great material. So options basic, this is good for anybody that's looking to trade options or getting into options for sure. And then how I trade those options finally is a great one to get involved in, because really we go into detail as to implementation. It's not about knowing how to build these strategies. I mean, I see guys, I do webinar deals with everybody else, and there's like a lineup of people, and they cherry pick the trades and stuff like that. If you put this butterfly 20 ticks above the market, you would have made money. Well, yeah, but that strategy is a low probability strategy, and you even put it in a lower probability of success type of environment and everything else. So stay away from that pitfall. I'm trying to be a straight shooter here. I want you guys to be successful. Why? Why do I want you guys to be good traders? Because listen, we don't all have the same directional assumption. You and I might be thinking about different things, and what we are doing is creating better markets. If there are better markets, free market price discovery is in full swing. That is better for everybody, okay? So, and take all those rich guys' money from TV, right? Okay, so without further ado, this is the link right here. I'm going to throw it in the chat window right now. So that's a hot link over in the chat window. You can get immediate access to this. I can tell you that if you're watching TV and trading options, it's cost you're getting free education, but it's costing you more than $297 in that education, because they're not giving you the right information. And, regularly we charge a lot more for that. I mean, 10 times more. So if you were to buy them all individually, and with this, you're getting a great deal. So it's over there in the chat window. If you're watching this on tape delay or, on the replay, you made it all the way to the end, you're going to have to pause it and punch that into your URL. I see a couple questions popping up, so I'll get to those in a second. Later webinars, I'm going to be drilling down on different option components where I find those appropriate. Again, here is that link for the webinar. And thank you. If you have any questions, reach out to us at 310-598-6677 or email me at trading@protraderstrategies.com. Before you close, yes, I got you. And very grateful for what you have taught me. Thanks, Banu. Appreciate the kind words. John, yeah, John, I got you. The other John, thank you. I appreciate that. Why don't you put the chart? Why don't you put up a chart of the IV rank in the different color at the bottom of your stock charts? Why don't I, or why do I? I do put the IV implied volatility down here. I put that down there because, sometimes I don't even need to figure it out. I just know, okay, this is a premium selling opportunity, and when it's way down here, I just kind of look at it. I don't have to come up with the percentages. I know this is right in the middle is 50, right? And if it's below 50, I'm good to be buying. And if it's above 50, I'm looking to sell it. Nancy, I don't know what the rank is. All right. And then let me see if I can't find this without pulling up all that. You're going to have to bear with me, John. I'm going to stop recording, though, now, you guys. If nobody else has any further questions, you guys, if you can't take that,